So where we are today, well, liquidity being the main driver leads the business cycle. It bottomed in exactly the same time the NASDAQ and crypto bottomed, which was October, November, December 2022. And it's been going up, and those markets have gone up. And they lead because they follow liquidity. Most other instruments, the Russell 2000, oil prices, copper, they tend to be living in present day business cycle, which is today, which is just picking up. So you're starting to see commodities still rock bottom, starting to pick up. You're starting to see Russell 2000, you're starting to see the equally weighted S&P now all-time highs. You're starting to see that happening. So in terms of markets, what we've got is probably 18 months of phenomenally good returns. You could throw a dartboard blindfolded and make money.
With its most recent monetary policy decision, the Federal Reserve has maintained stability in interest rates while leaving the door open for further changes. The markets throughout the world are being affected by this, which comes after months of uncertainty over whether the Fed will keep up its rapid rate hikes or taper off. Macroeconomic specialist and founder of Real Vision, Raoul has been attentively observing these trends and feels that both the traditional and crypto markets are about to enter a critical period. Pal believes that this might be a big turning point for liquidity conditions, with the potential to drive large gains in important asset classes such as cryptocurrencies and tech stocks. Despite the current market turbulence, Raoul believes that the Federal Reserve's actions will ultimately pave the way for what he sees as an exponential growth cycle, especially in the cryptocurrency field. This is according to his most recent research. He believes that rising liquidity and positive macroeconomic factors will cause Bitcoin and other cryptocurrency assets to rise over the coming years. Next, we'll delve into Raoul Pal's views, analyze his predictions for the cryptocurrency space and international markets, and consider the implications for investors. Before we begin, don't forget to like this video, subscribe, and turn on notifications for more expert financial insights. Let's hear his following words.
So how I look at markets is I use a combination of the long-term secular trends, what things are trending over time, then the business cycle, and then liquidity. And I found over the years, my framework's been adapted as I've understood more and more that liquidity has become almost the total driver of returns. And then you get some excess returns for secular trends. When you break down what I mean by all of that, the business cycle, as we know, goes up and down. You can use the ISM as a way of understanding the business cycle. We're currently at the turning point of the business cycle, where on a forward basis, we should see the economy improve. So the calls of recession stuff, that was from 2022. Right now, we should be seeing expansion on the road ahead, whilst the rates are coming lower. But what I found in my work over the years is I uncovered something that I refer to as the everything code, and which is a bit of a kind of hubristic title, but it was really shocked me. I think I was one of the first people in the world to find that what had happened back in 2008 was we had a global debt reset. As opposed to a debt jubilee where you don't pay any of the debts back, you had an interest rate jubilee. And so what happened is all of the major central banks and governments around the world agreed not to pay interest. That's what zero interest rate policy was. We kind of were sold that it was a story of we need stimulation. It was not stimulation. What it actually was a jubilee, and you don't need to pay your interest rates. Why? Because all of the governments around the world have got to 100% of GDP in debt. Now, when you're 100% of GDP in debt and you have an aging population, you tend to have slow GDP. So GDP, trend rate of GDP in the US, about 1.75%. Let's call it 2% for easy maths. And let's say average interest rates over the last 10 years have been 2%. So 100% of all economic activity goes to pay the interest payments on the debt. Issue is the corporate sector is over 100% of GDP in debt. This is the only game. Everything else is irrelevant. Every single asset class, every single economy, every single central bank is all highly correlated based on this debt cycle. Why this debt cycle? Well, back in 2008, everybody reset their interest rates to zero and then restructured their debts maturities at all government level from 3 to 5 years. So you've got a 4-year cycle, and it's perfect. It's also exactly what happened in the 1950s after World War II, because we had the same issue then, and we did the same thing then. And as opposed to zero interest rates, what we used then was yield curve control. So, okay, we understand that. But what they're doing is every time the debts come due, which is this year and next year, we've got 10 or 11 trillion in the US alone of debt to roll over, they print money in the form of liquidity. It's not just the balance sheets. Every aspect of liquidity you can find in the system, they understand the game. They all do it together. And they're doing it now. So liquidity is the driver. So when you start adjusting markets, this is the magical thing. Once you adjust the S&P 500 by Fed net liquidity, the largest measure of liquidity in the US, the S&P 500 has gone nowhere since 2008-9, because it fell in 2008. It's gone nowhere, almost zero returns in real terms. Gold, same. Real estate's different because you use leverage, but if you would use unlevered real estate, it's gone nowhere. In fact, no assets have gone anywhere except two. There's only two assets in the world that outperform debasement of currency. Debasement is the excessive printing of currency to pay your own debts, using a credit card to pay a credit card, for example. It's only technology, and it's only crypto.
After many rate cuts from the Federal Reserve and other central banks, Raoul believes we're headed for more cowbell, basically a large dosage of money printing to save the world financial system from collapsing entirely. The markets will be inundated with this enormous infusion of cash, particularly the notoriously volatile cryptocurrency space. After the rate decrease announcement on Wednesday, Bitcoin shot up to $61,500 in a matter of minutes, giving us a taste of that volatility. Raoul, however, believes that the real fireworks would occur when money printing starts, which might happen as early as 25. He believes that there will be even more wild swings in the price of Bitcoin and other cryptocurrencies, with the latter perhaps rising by thousands of dollars in a single day. This is what Paul refers to as the banana zone, the period in any cryptocurrency bull market when values explode, reaching nearly unfathomable heights. He thinks there is still a lot more to come, and that we have only just entered the banana zone. Now, let's get back to his speech.
So where we are today? Well, liquidity, being the main driver, leads the business cycle. It bottomed in exactly the same time the NASDAQ and crypto bottomed, which was October, November, December 2022. And it's been going up, and those markets have gone up. The other and they lead because they follow liquidity. Most other instruments, the Russell 2000, oil prices, copper, they tend to be living in present day business cycle, which is today, which is just picking up. So you're starting to see commodities still rock bottom, starting to pick up. You're starting to see Russell 2000, you're starting to see the equally weighted S&P now all-time highs. You're starting to see that happening. So in terms of markets, what we've got is probably 18 months of phenomenally good returns. You could throw a dartboard blindfolded and make money. So that's great. It's one of those great times where the business cycle's going up, interest rates are coming down, liquidity is coming into the market.
Over the next, I guess, 15 months.
15, and some of these lag, commodities will keep going up probably into 2026, mid-26, because it gets inflationary later in the cycle. Yeah. So we've got a really nice period ahead of returns that we can all call ourselves geniuses, which is nice. Don't forget, step back, all of the noise you read, all of the stuff. Rates are at 5.5%. Headline CPI is at 2.5%. Truflation, which I think is built on Chainlink,
that's right,
is at 1%. Right? Rates are 300 basis points too high. They're going to come down a lot. Everyone's going to feel a lot better. Spending's going to come back. Corporate earnings rise. Everyone's going to feel great, and the cycle will repeat. 2026, the cycle slows down again, and then we go through the same debt refi cycle all over again. Oh, and the other function of this is financial conditions are also easing. Financial conditions, we find the best measure of financial conditions is the dollar, which has been weakening. It should do at this point in the cycle. Commodities, which have been relatively weak, which is great. Normally they'll start picking up very soon. And then rates, which will come lower. So we've got financial conditions easing, the Federal Reserve easing, most of the central banks easing. We've got stimulus coming from almost everybody, the Fed less so yet. The Chinese are leading it because they've got the slowest economy. So it's all to look forward to.
According to Raoul, liquidity is currently the primary driver of the business cycle. He makes note of the fact that liquidity reached a low point in October to December 2022, coinciding with the Nasdaq and cryptocurrency markets, and has since been gradually rising. These markets increase along with liquidity because they are closely linked to liquidity movements. Commodities and the Russell 2000 are two other markets that move more in step with the current business cycle and react more slowly. Pal observes that we are about to enter an amazing return phase that will probably endure for about 18 months. You could throw a dartboard blindfolded and make money, he said, referring to the beginning of recovery in commodities and Russell 2000 markets. Additionally, he projects that commodities will keep rising until roughly 2026, at which point they will be impacted by inflationary pressures later in the cycle. People will feel more confident as interest rates decline and liquidity rises, which will raise spending, boost corporate earnings, and improve market sentiment overall. Raoul believes that we are therefore in for an interesting time ahead. With increased liquidity and anticipated declines in interest rates, the conditions are favorable for market expansion. The next 18 months might yield incredible gains on stocks and commodities alike. But for now, everything is looking up. Thank you for watching, and remember to hit the notification bell, like, and subscribe for more videos like this one.